Shares of Visa, the payment processing giant, have climbed by 32% over the past year, but our guest believes there are more gains to come in the stock. We're back with Brianne Gardner. She's Senior Wealth Advisor at Velocity Investment Partners, Raymond James. Let's begin, Brianne, with why you like Visa after a pretty good run, as I've just said, over the past 52 weeks.
Yeah, and I do think there's still more upside. We see about double-digit upside still from here, about 12%. I think we have a price target around that 389 roughly. I mean, they just also defeated a class action lawsuit over gift cards, which is, showing the company's resilience. I think that Visa has maintained, that dominant duopoly with MasterCard in the global payment processing. But the real story here is how consistent it has delivered. I mean, yes, you can see it has had some swings over the longer term, but the stock is a resilient stock that we do like. I think the latest earnings, they beat both revenue and earnings per share estimates, extending an 8-quarter streak of outperformance. So for us, that consistency we are seeing, and Visa benefited from rising transaction volumes with people buying ahead of the tariffs and stocking up again. So they are still expanding beyond payments as well, headed into the value-added services now that are making up over 25% of their revenue. And that's really driven by the high margins areas like fraud prevention and data services. So again, where the stock is, even amid some of the stable coin competition concerns, I still see that Visa's long-term opportunity does remain enormous. And we see, 200 trillion total addressable market. So for us, it's still a stock that we own and continue to hold in the portfolio.
Okay. You also like Salesforce, a pioneer in the software as a service model and a provider of customer relationship management software for companies around the world.
Yeah, and I don't think CRM or Salesforce value has been priced in yet. As you can see on this chart, it did hit highs over that 360 and still 1 year only up about 6.9%. So for us, we see an upside potential of almost 30% here. You're not getting a huge dividend, but you are, the value and the growth upside. I see, 1 year revenue growth is 8.73, year revenue growth about 13%. And same thing, 1 year earnings growth about 51%. So for us, they did launch the Agent Force in August to support their new AI-powered feature, again, headed into that market heavily, an acquisition that's supposed to be completed in May of this year, which was great news for the company. And they are still a global leader in that CRM, or the customer relationship management software. And we like Salesforce because it's no longer just that. It's not just a CRM company. It's becoming the operating system for the modern enterprise, right? So you're seeing reoccurring revenue from AI and data cloud that has surpassed over $1 billion, up 120% year over year. And a big part of these top deals now includes that AI component, which I think Salesforce, again, hasn't been priced in the stock yet. So to us, the valuation still remains attractive, trading at around 22 times forward earnings, near the low end of really the historic range. So again, Salesforce is a stock that we see a lot of upside from here.
And the final pick we want to talk about is WSP. That's the Canadian engineering giant.
Yeah, WSP. So we see about 8% upside, 8 to 10% upside from here. 1 month, the stock has had a little bit of a sell-off, down almost 2%, but it is still, as you mentioned, global consulting that does help design, manage major infrastructure and energy products around the world. So think of roads, transit systems, real estate, environmental planning, and has had a little bit of a run up since those low in April, but we still think there's more of a leg up from here. And I do like the industrial sector for their strong demand and stable cash flow. At the beginning of the year, the industrial sector was expected to see about 20%, 18% earnings per share growth. And I think that WSP stands out here for its discipline, global reach, and sector breadth. And I do see the company still offering more of a unique resilience in the macro environment. So, we saw Q1 results were strong, earnings and revenue both beat estimates. And the order book hit a record 16.6 billion. That is giving 11 months of revenue visibility going into Q3. Very positive for us. They are also acquiring a UK-based company, expanding into, again, that high growth area like rail, air quality, energy. And I think this deal will add a lot of value. It's expected to deliver, I believe, 2 to 3% in cost synergies, making that margin, again, very favorable. So for us, I think this is Canada's new landmark infrastructure bill, also offers some upside. So we see the company still remaining, even with potential domestic slowdown, still remaining resilient through all of this tariff.